Irani joins us. And in this market, it's not only Dinshaw, everybody is smiling. So there's nothing new if you smile today, right? Everybody is smiling in this market.
Yeah, I guess.
But the point is that how long will the smiles continue?
Yeah, that's the right question, I think, Nikunj. Thank you for having me on your show. It's always a pleasure to come on your show. But anyway, so Nikunj, the fact is India got re-rated, right? And re-rated big time also because our average Ps were 17, 18, and now we are at 23, 24 forward earnings, right? Now, for this re-rating too, I mean, the re-rating happened on the back of obviously the balance sheet is becoming stronger, the growth rates are becoming much more exciting. So to maintain that re-rating, one has to now, I mean, balance sheet still remains stronger, right? There's no issue on that. But the earnings growth have tapered off. In fact, in the last 2 quarters of reported earnings, they're not supporting the kind of valuations we are at. So we are slightly concerned on that basis. And frankly, I mean, looking at September, half the quarter is over, literally. I mean, rather more than half, 2/3 of the quarter is over. Doesn't look that exciting either. So it's obvious that there may be some stretches on certain pockets where there's been a lot of froth building up as such. So we are concerned.
Okay. Dinshaw, the correction in the defense and the railways and the PSUs and the shipyards has already started. How come nobody is talking about it?
We've been actually been talking about this for a while. I mean, I don't know about others, but what we did was in the run up to the budget, we sold off quite a bit of PSUs. We sold off, in fact, in the oil and gas space, we sold off, chopped off rather some weightages in defense. We had one railway stock which was more of tourism stock. We moved that out. So we've done our I think we got our shopping cart down to manageable levels as such. So I think that's what we did in the run up. But frankly, I mean, as in Nikunj, look at the what happened on 23rd, right? The budget wasn't that exciting for the PSU space as such. There was a cut and spend, so it's obvious that this won't last for long. I mean, this kind of euphoria in that space. And the spoiler was obviously the capital gains, and you saw that the FIs have been constantly dumping after that. I mean, they've been buying in bits and pieces, but that's only when there's a offer available at a massive discount and that's an insider offer which is coming, which anyway is not a good news for the markets. So only then they buy, otherwise they've been out of the market and they're remaining negative. I think the only thing supporting the markets today is obviously the domestic flows, which continue to be fairly healthy.
Dinshaw, hi, morning. Wondering whether IT is the contra call that one should have jumped in the month of April. Now, of course, the index is at an all-time peak. But just wondering whether there's further headroom to go from here or not. Because, the commentary from an LTI Mindtree, from an HCL Technologies at their investor day, all seems to be pointing to a demand recovery.
So Aisha, let me let you in on a secret. Actually, you would have seen our July end portfolio anyways. So we turned constructive on IT after TCS results. Actually, I think TCS was an eye-opener. And frankly, I mean, for us, TCS is a bellwether because he's been not calling out, but you've got to read between the lines when TCS is, they never give out any numbers. But if you read between the lines, the fact that they added to their employee strength, and the call was also pretty instead of disdainful, it was very positively structured and stuff. So we took away that hint and we started adding to that. And frankly, I mean, so when we are not too comfortable in markets, normally money goes towards safety, right? In the case of IT, the stocks are available at more than half the PEs of FMCG, and the growth rates are better than the FMCG bunch as such. So it's obvious that this is, for us at least, this is a place we can be very easily park our money and see some growth coming through, and especially in times when the markets are looking a bit jittery to us. So it's better to be in a space which is going to give you a healthy return of 12-13% in terms of earnings. And obviously the P is also very at sensible levels as such. They're probably at par with what they were earlier as such. So they were not re-rated. And frankly, I mean, that's not the only space. We also like the non-lending finance. I think that's another space that needs to be looked at.
But IT, the logic was that okay, the sector is not growing and valuations are above their 5-year average. Valuations never came below their 5-year average. And what growth are we talking about? 8 becoming 11 or 9 becoming 12? And the stocks are up 30-40%, right?
No, no, no. So 9 becoming 12 itself is like a 33% growth, right? So in terms of growth rates.
You're
But
splitting the
anyway,
hair
fine.
wali
I mean,
baat ho gayi, right? I'm splitting the hair, right?
no,
There
no,
are a
no,
lot of
no, no.
other businesses where growth is 15-20%, my friend.
No, no, no. I'm coming to that. I'm coming to that. The fact is that what we were concerned about was that the new technologies coming in will create a problem for these guys. And obviously, I mean, the more you look at it, the more you hear these guys, it's obvious that AI and generative AI and all these guys are going to add to their businesses rather. So that's one area that you need to look at. And frankly, I mean, Nikunj, you're right in the sense that 12 may become 14, 15, right? Because 12 is right now what the estimate is. And frankly, I mean, none of these managements, in fact, HCL Tech yesterday finally gave some kind of indication that medium term looks pretty healthy. They didn't call out the short term, immediate short term, but they called out the medium term looking fairly good. So one can probably see that the growth rates may come back to their mid to high teens as such in this case. And that's why I think this is the time to be in a sector where you're sure of the growth. And frankly, I mean, the valuation is also in sync with what you've seen. You talked about the last 5-year averages. Obviously, the 5-year averages had a COVID period where the valuation just shot through the roof, right? But if you look at the pre-COVID period, they were at 19, 20, and they are at 23, 24 times forward earnings as such, which is fairly okay for us, I think.
Other than IT, wondering where else would you have added positions in the last 3 months?
So I won't give out the names, Aisha, but obviously we used to hold one IT stock which was into the automation space. I mean, as in the auto space. So that we added to. Plus, we added to the heavyweights in IT, and we picked up a few more names beyond that also as such. So probably 5 odd names, and obviously the platform companies, which we believe are IT companies as such. There again, we've increased our exposure to that extent.
So if to buy something, you have to sell something. What did you sell?
So as I said, we cashed out a bit on the PSU space. So we had that money lying with us, and that's why we got there. We chopped a bit, rather trimmed a bit on the tourism space because we thought there was a lot of fraud building up there. Though we continue to be very bullish there. In defense, we chopped a bit, and yeah, that's how we made our cash as such. So, and fortunately, mutual fund, you don't need to sell anything to buy anything. It's the money keeps flowing in, so you keep buying new stocks which you like. So that way, that used to be the case in our PMS where we have to sell something to buy something.
Dinshaw, one big moving part would be interest rates will come down globally, hopefully locally. Now, purists would say interest rates are like gravity. When they go up, valuation should go up or down, and when interest rates go down, valuation should go higher. Are we looking at this reversal at play, whether it is for commodities or for high growth companies, that now impact of low interest rate would be visible in terms of valuations?
So actually, Nikunj, I think that consensus trade has already played out. I think I won't be too surprised if it's sell on news once the interest rates start getting cut out there, and depending on what aggression they come up with. But I don't think they're going to be too aggressive in the first space because, as I've already pointed out earlier, both, even if say either of the two candidates, if they come up as such, Kamala or Donald Trump, they're going to be both inflationary for the economy as such. So I think Fed is going to just give out a token cut and probably wait out what the new policies are and before taking aggressive cuts. Our feel is the aggressive cuts can only start in by the end of this year or say beginning of next year as such. That's when the real kicker will come in. And in the case of India per se, the real interest rates have been very high all along. And that's why we always believe that the private sector, given there's a paucity of demand and the fact that the real interests are so high, they will not undertake a capex at this point in time. They wait for these rates to come down, demand to pick up. One big indicator will be when RBI starts infusing some liquidity into the system as such. Despite sucking out the liquidity, you can see the pressure on the rupee on a regular basis. I think that's one thing that has to be looked out for before taking a call on interest rate sensitivity in India.
Dinshaw, when you see the market from the lens of safety. Apart from IT, where else do you think there is safety with decent growth?
So one area that we've been always bullish on, Nikunj, and we continue to be bullish on is obviously right now, I mean bullish as in I'm talking about a medium to long term, is the banking space. But in the non-lending space of financial services, I think that's a fantastic area to be in. Though the valuations are looking a bit stretched out there, but I think there are pockets which are still giving you good growth and which continue to give you good growth as such. So I think that is one area that one needs to look at. And frankly, I mean, if you look at my financial services fund, I think banking space is around 65%. The rest all is services. And probably we're one of the few who has around 24-25% exposure in small caps in the financial services front. So that's what is exciting to us. And I think we keep finding new ideas out there. And frankly, I mean, as I said, there are a lot of options even in the platform companies in that space. So anyway, yeah.
Companies are offering margin of safety, Dinshaw, and we are discussing how stock like Policy, Fintech, and Paytm. 2 years ago, they were at bombed out valuations, right? Tencent sold their stake in Policy Bazaar or PB Fintech at 400, and today they've sold at 1700. So what has changed?
So I think basically this is the way to go. So what do you look for in a platform company? Because one, they have to be globally established formulas, right? So that's most of the most of the domestic players which are successful are globally established plays. Secondly, is there convenience being offered? Yes, most of them offer conveniences, right? Secondly, is it encashable convenience? And is it mass and encashable? It is, right? And are they easily replicable? They're not. That is the big question, I think. And that's why we don't like certain platform companies which we believe are easily replicable. And that's why we're very clear on those which are not easily replicable as such. And those are the companies that we want to be in. You named a few of them. Obviously, we continue to be there. In fact, one of them we've added weight to recently, given that the regulator has been, regulatory action has taken a backseat. In fact, the regulator has been fairly benign towards that particular, where he came down heavily earlier. He's been fairly benign now, and I think things are looking pretty ripe out there.
They are. Dinshaw, always good having you on the show, and hope the smiles continue.
It will. Thank you.
Okay.
If you like this video, then like, share and subscribe to ET Now.